Imagine staring at a stock chart and thinking you can predict the future. Sounds like astrology for people in suits, right? Well, millions of traders do exactly that every single day, and some of them are actually onto something. Technical analysis is basically the art of reading price charts, the way a detective reads clues at a crime scene. Instead of asking, is this company good? You're asking, where is this price going next? Here's the wild part. It doesn't care if the company makes rockets or rubber ducks. All it cares about is what the price did yesterday, last week, and last month, because those patterns tend to repeat like your favorite TV show doing a reboot. Think of a price chart like a mood ring for a stock. When prices keep climbing higher and higher, we call that an uptrend. And when they keep sliding down like a kid on a water slide, that's a downtrend. One of the most popular tools traders use is called a moving average, which is just the average price over a set number of days, like 50 or 200. It smooths out all the crazy zigzag noise so you can actually see where the trend is heading without losing your mind. Volume is another big deal. And no, we're not talking about turning up the speakers. Volume tells you how many shares are being bought and sold. And when a big price move happens with huge volume behind it, traders treat that like a green light saying, this move is real. Here's something funny. People spent centuries trading without any of this, just vibes and word of mouth. Then in the 1800s, a guy named Charles Dow basically invented market analysis and laid the groundwork for everything we now call technical analysis. One of the most talked about patterns is called a head and shoulders, which sounds like a shampoo brand but is actually a warning sign that a trend might be reversing. When traders spot it, some of them get so excited you'd think they just found buried treasure. Support and resistance levels are another core idea, and they're beautifully simple once you get them. Support is like a floor, where the price keeps bouncing up, and resistance is like a ceiling, where the price keeps getting blocked from going higher. Now here's where a lot of beginners trip up. They think technical analysis is a crystal ball that's always right. It's not a guarantee, it's a probability game. Like knowing it usually rains in Seattle doesn't mean you'll never see sunshine. The real power shows up when you combine multiple signals instead of relying on just one. Think of it like a jury. You wouldn't want one person deciding someone's fate. You want several indicators all agreeing before you make a move. Technical analysis shines brightest in short-term trading, like day trading or swing trading, where you're in and out of positions quickly. Trying to use it to figure out where a stock will be in 10 years is like using a weather app to plan a vacation in 2035. The trading community is huge and full of people sharing chart setups, debating patterns, and tagging each other in screenshots at 2 in the morning like it's perfectly normal behavior. That shared language of lines and patterns actually helps because the more people watch the same levels, the more those levels tend to matter. The honest truth is that the best traders use technical analysis not to predict the future perfectly, but to make smarter decisions about risk and timing. It's less about being right every time and more about having a logical reason for every move you make. So the next time you see a chart full of lines and squiggles, just know that there's actually a whole system of thinking behind it that's worth understanding. And if you want to learn more about how we break down topics like this, go check out our links in the description. Do you want to keep exploring with us?